A Ponzi scheme is a fraudulent investment operation where the operator, an individual or organization, pays returns to its investors from new capital paid to the operators by new investors, rather than from profit earned by the operator. Operators of Ponzi schemes usually entice new investors by offering higher returns than other investments, in the form of short-term returns that are either abnormally high or unusually consistent. The perpetuation of the high returns requires an ever-increasing flow of money from new investors to sustain the scheme. The scheme is named after Charles Ponzi, who became notorious for using the technique in 1920. The idea, present in novels, was actually performed in real life by Ponzi, who with his operation took in so much money that it was the first to become known throughout the United States. Ponzi's original scheme was based on the arbitrage of international reply coupons for postage stamps. However, he soon diverted investors' money to make payments to earlier investors and himself. Characteristics: typically, extraordinary returns are promised on the original investment, and vague verbal constructions such as hedge futures trading, high-yield investment programs, or offshore investment might be used. The promoter sells shares to investors by taking advantage of a lack of investor knowledge or competence, or using claims of a proprietary investment strategy which must be kept secret to ensure a competitive edge. Ponzi schemes sometimes commence operations as legitimate investment vehicles, such as hedge funds. For example, a hedge fund can degenerate into a Ponzi scheme if it unexpectedly loses money and the promoters, instead of admitting their failure to meet expectations, fabricate false returns and, if necessary, produce fraudulent audit reports. A wide variety of investment vehicles or strategies, typically legitimate, have become the basis of Ponzi schemes. For instance, Allen Stanford used bank certificates of deposit to defraud tens of thousands of people. Certificates of deposit are usually low-risk and insured instruments, but the Stanford CDs were fraudulent. Initially, the promoter will pay out high returns to attract more investors, and to lure current investors into putting in additional money. Other investors begin to participate, leading to a cascade effect. The return to the initial investors is paid out of the investments of new entrants, and not out of profits. Often the high returns encourage investors to leave their money in the scheme, with the result that the promoter does not have to pay out very much to investors. He simply has to send them statements showing how much they have earned. This maintains the deception that the scheme is an investment with high returns. Promoters also try to minimize withdrawals by offering new plans to investors, often where money is frozen for a longer period of time, in exchange for higher returns. The promoter sees new cash flows as investors are told they cannot transfer money from the first plan to the second. If a few investors do wish to withdraw their money in accordance with the terms allowed, their requests are usually promptly processed, which gives the illusion to all other investors that the fund is solvent. Unraveling of a Ponzi scheme: when a Ponzi scheme is not stopped by the authorities, it sooner or later falls apart for one of the following reasons: the promoter vanishes, taking all the remaining investment money. Since the scheme requires a continual stream of investments to fund higher returns, once investment slows down, the scheme collapses as the promoter starts having problems paying the promised returns. Such liquidity crises often trigger panics, as more people start asking for their money, similar to a bank run. External market forces, such as a sharp decline in the economy, cause many investors to withdraw part or all of their funds. Similar schemes: a pyramid scheme is a form of fraud similar in some ways to a Ponzi scheme, relying as it does on a mistaken belief in a non-existent financial reality, including the hope of an extremely high rate of return. However, several characteristics distinguish these schemes from Ponzi schemes. In a Ponzi scheme, the schemer acts as a hub for the victims, interacting with all of them directly. In a pyramid scheme, those who recruit additional participants benefit directly. A Ponzi scheme claims to rely on some esoteric investment approach and often attracts well-to-do investors. Whereas pyramid schemes explicitly claim that new money will be the source of payout for the initial investments. A pyramid scheme typically collapses much faster because it requires exponential increases in participants to sustain it. By contrast, Ponzi schemes can survive simply by persuading most existing participants to reinvest their money, with a relatively small number of new participants. An economic bubble. A bubble is similar to a Ponzi scheme in that one participant gets paid by contributions from a subsequent participant. A bubble involves ever-rising prices in an open market where prices rise because buyers bid more because prices are rising. Bubbles are often said to be based on the greater fool theory. As with the Ponzi scheme, the price exceeds the intrinsic value of the item, but unlike the Ponzi scheme, there is no single person misrepresenting the intrinsic value. See also, List of Ponzi schemes, Bucket Shop, Get-Rich-Quick Scheme, Matrix Scheme, White-Collar Crime. References. Further reading, Frankel, Tamar. The Ponzi Scheme Puzzle, A History and Analysis of Con Artists and Victims. USA, Oxford University Press. ISBN 0199926611, Dunn, Donald. Ponzi, The Incredible True Story of the King of Financial Cons. New York, Broadway. ISBN A0-7679-1499-6. Zukoff, Mitchell. Ponzi, a Euro unregistered trademark S scheme, The True Story of a Financial Legend. New York, Random House. ISBN A1-4000-6039-7. Leila Schneps and Karali Kolmes, Math on Trial. How Numbers Get Used and Abused in the Courtroom, Basic Books, 2013. ISBN 978-0-465-03292-1, The Mathematics of Ponzi Schemes, Arts Roney, April 2009, external links, Ponzi Schemes FAQ information and advice from the U.S. Securities and Exchange Commission, What is a Ponzi Scheme? Ponzi Scheme definition with distinctions, history, and other information, Ponzi Scheme illustration of a Ponzi Scheme, the Ponzi Scheme and tax loss describing U.S. tax recovery methods, Ponzi schemes on Khan Academy. The importance of being diligent case studies on prominent hedge fund Ponzi schemes, fraud awareness and prevention information about spotting fraud from the U.S. Commodities Futures Trading Commission, Ponzimonium free ebook about Ponzi schemes from the U.S. Commodity Futures Trading Commission.